Okay, so having explained that I'm sort of slightly challenged in the distance, thank you very much for the opportunity to come and speak to you. It's a very welcome opportunity to come and talk about the work that we're doing in the department and the work that we're doing with the rest of Europe in terms of accounting. As been mentioned, I work within the Department for Business Innovation and Skills. We have responsibility for the company law framework in the UK. That encompasses everything from financial reporting, narrative reporting, various obligations on directors, obligations to file with Companies House in the UK, the registrar. So quite a breadth there. My interest is very much in terms of the financial reporting framework and the statutory obligations within the UK, and hence my links into Europe on this particular area. So I'm currently working on the implementation of the European Micros Directive and taking that through into UK legislation. We are finalising, hopefully today, the discussions and the agreement of the new Accounting Directive in Europe. We're looking ahead to implementing new rules on extractives, but as that's for very, very large companies, of less interest for this audience, and obviously looking to take forward the implementation of the Accounting Directive itself. I represent the UK's interests on the Accounting Regulatory Committee within the EU, which some of you will be aware its purpose, structure, membership is under review as part of the work of Philip Maystadt, the Special Advisor to Commissioner Barnier, in terms of looking at governance arrangements for implementation of accounting standards within the EU. But also, and something that's not really developing too far at the moment, is I'm on a group within the EU looking at reporting requirements for SMEs who are not incorporated bodies. So an area that the Commission is starting to take an interest in as well. And possibly of less interest for this audience, I'm also working with colleagues in BIS who are part of the Red Tape Challenge, which is the government's efforts and initiative to reduce bureaucracy and the requirements that are imposed in business. Okay. I have quite a lot of slides, and I hope they'll be made available to you, because I don't think they're in the packs at the moment. So I'm not necessarily going to read everything off the slides, but hopefully in the time available we'll be able to crack on through that. We're a little late, so I will sort of try and take this at a pace. Okay, so the European context. Three particular areas here for us. Smart Regulation in Europe paper talked about wanting high quality regulations but respecting principles of subsidiarity and proportionality. For any of you who are familiar with the European negotiations, each member state, each government is very precious about its own powers and its own responsibilities, and clearly the Commission tries to sit above all of those self-interests and to bring about legislation that is appropriate for all. Think Small First, a Business Act for Europe, another Commission paper, looking to anchor a Think Small First policy within the EU's regulatory framework, and you'll see some of this in practice as we move on to the discussion of the Accounting Directive. It recognises the importance of small and medium-sized enterprises within the EU. It sees them as a significant driver for growth and essentially the bedrock of business health within the community. So Think Small First, a very big policy in terms of member states' approaches to this. And the intention is that it's the underpinning principle. So even as you look at some of the legislation that's coming through on quite different topics now, This is really starting to influence where the EU's thinking is going. Two key directives relevant to this particular topic, accounting for SMEs and particularly small entities at the moment. The first is Directive 2012-06 EU, which is referred to in the UK as the Micros Directive. It revises elements of the fourth Accounting Directive. Would probably more accurate to say it amends and adds to aspects of the fourth Accounting Directive. And what it does is it creates a new category of company. There are other guidelines within Europe that recognise micro businesses. Micro entities are very specific, and this is the first time that there's been an attempt to relieve burdens on businesses, specifically at this level of the business structure. The original attempt with the Micros Directive was to take all the relevant companies out of EU regulation completely. That wasn't an objective that could be achieved. Member states couldn't agree on that or the advisability of that. So the Micros Directive is very much a compromise, and may touch on that as I move forward, or perhaps in the discussions later. The Commission proposal 2011-03-08, that's the new Accounting Directive, revises and repeals the 4th and 7th Accounting Directives and all of the amending directives. Its objective was to simplify what was happening with the 4th and 7th directives. It was quite complicated. There were a lot of amendments to them. They've been around for a very long time. It consolidates, revises and restructures. It looks to impose greater harmonisation in the approaches across the EU. And from a UK perspective, we're very pleased that working with other member states that we've managed to win some major changes to the original proposal. So things around greater flexibility on the formats. We have merger accounting reinstated into the Accounting Directive. It was originally removed. And importantly for this audience, an ability to require a greater number of notes for small companies to assist with a true and fair view. There's lots of changes in the new Accounting Directive, some of them presentational, but importantly there's a new chapter which deals with transparency for extractive companies, and arguably for the purists among us it's no longer merely just an Accounting Directive. So Micros Directive, it has a very long title, it's a very small directive, but believe you me, it's created a lot of problems. The reason for that is it doesn't fit very well within the UK's existing regulatory regime. Important to point out that it only deals with the 4th Company Law Directive, so the changes that are proposed here only apply to individual company accounts, they don't apply to group accounts, and there are no changes whatsoever in terms of any audit obligations. It is only intended for, that's not to say that it's only available to, but it's only intended for simple companies with simple information requirements. The objective of this directive was very much to allow small companies, which generally are owner managed across the whole of the EU, that's not necessarily the case everywhere, basically to be able to do this for themselves, to do sufficient to enable them to make a report on the progress of their business. Essentially allowing them to focus on developing the business rather than fulfilling bureaucratic reporting requirements for the state. The view was that they're largely owner managed, that they get their credit from trade creditors, and that they are simple businesses. At least that's the theory. So what is a micro entity? It's a company, so it's only incorporated companies, it's not businesses more widely, which on its balance sheet date doesn't exceed 2 of those 3 criteria. Interestingly, it's any 2 of those 3 criteria, so there was quite a lot of debate about the undesirability of certain companies within group structures who might be able to fall into this. and there are perhaps some issues in practice that we may need to keep an eye on. But this is the intention. The sterling values are at the end. They're rather odd sterling values. We would normally in practice have round thousands. We try to make them easy. A couple of things here. The exchange rate is set by the date on which the directive comes into force, which is 20 days after it's published in the official journal, and that gives us those figures. The UK government has a policy against gold plating, which is to make any changes or add sophistication to information or requirements that come out of Europe. And the other thing is we don't have the ability to round up, we only have the ability to round down, so you could argue it wouldn't affect many people, but potentially if we knocked the £415 and the £830 off, there would be some micro companies out there who would be excluded. So the decision was taken, we would take the numbers as they were given. It cannot emphasise enough that they only apply to the financial statements. They do not apply to any other requirements. So what does it commit? So the directive is entirely permissive. Member states have the opportunity to implement any, all or none of it. Government policy in the UK is to reduce burdens on business wherever possible, and particularly for small companies, and that's actually embedded within the coalition agreement. So a very clear policy direction on this. So our starting point in considering the directive was that wherever reasonable we should look to implement the options unless there was strong evidence to indicate that it would be inappropriate to do so. Essentially, the options are about presentation and the level of information that's required. A couple of important things to point out here. So the directive talks in terms of requirements to prepare an annual report. In the UK, the EU requirements for an annual report are embedded within the requirements for the director's report. The director's report goes further than the annual report, so you cannot read annual report as director's report because there are two elements that small companies still have to report. Those relate to the nature of the business and purchase of own shares. You might wonder if it's worth that, but we'll look at that later. At the moment, we're just looking to implement the Micros Directive. So it provides the opportunity for greatly abridged profit and loss account. Essentially, this is all the information that a micro entity will have to prepare now, and it is prepare as well as publish. It will have the opportunity not to publish, but it must prepare. A couple of things in terms of UK legislation here. Net turnover in the UK, the regulations will just say turnover. That's to ensure consistency with the approach within the current company law arrangements. The other point here is value adjustments, which will also change and will say depreciation and other amounts written off from tangible or intangible fixed assets. So again, that's a straight match with the existing UK law. The intent is exactly the same. They can prepare an abridged balance sheet, prepare and publish. But importantly, so the two formats on the balance sheet, this is the first, this is the second, so as you can see, very much a greatly reduced level of information. They don't have to provide lines where there are zero numbers, so this could be considerably shorter in any case. But there's an important difference here between the approach within the fourth Accounting Directive and the opportunities for Member States to create a small company regime and the opportunities to provide it to Member States in terms of a micro regime. If you look at the fourth directive and the way it talks about the opportunity to provide abridged or in the UK abbreviated accounts for small companies, you prepare full accounts but you publish abbreviated. For micros, you can prepare abridged accounts And if you prepare abridged accounts, you can publish abridged accounts. If you prepare full accounts, you publish full accounts. So if you look at the specific wording in the directive, it's that you don't have to publish your financial statements subject to the balance sheet information being filed with the registrar. They're not quite the precise words, but the balance sheet information is the balance sheet prepared for shareholders. So if you have a detailed balance sheet prepared, you publish a detailed balance sheet. And this is going to be quite important because it's a significant difference between the Macros Directive and the approach within the Fourth Accounting Directive. And I regret to say that because of the politics of the Macros Directive, it took 3 years to agree this, 2009 to 2012. We are stuck with this. This wasn't open for renegotiation as it was incorporated into the Accounting Directive. You don't have to provide notes in general, but you have to provide 3 mandatory notes. Now, I apologise because this is a straight lift of the words that's in the directive, so it would be quite hard to read. So there's a requirement for all commitments of any kind if there's no obligation for them to be shown within the balance sheet as liabilities, advances and credits provided to members of the organisation, be they administrative, managerial or supervisory bodies, and a note on own shares. This is not compulsory within the small company regime at the moment. It's an indication of the degree of compromise that had to be found in negotiating the Macros Directive, that this is compulsory for the very smallest businesses. And certainly one of the things that UK consultation noted was the sheer effort that may be required for some small entities in terms of providing the detail of these notes. There are exclusions and limitations, so it's not available to micro companies who elect to take these options to use the fair value option. There's a very good reason for that. What it says is, if you're a small company, the intention is you are a simple company with simple information needs, you should not be in this sort of area. If you are in a situation where you actually feel that you should be using fair value accounting, then you shouldn't be preparing micro accounts, and they are specifically excluded from that within the Okay, so what's the UK approach to this? We've had quite a long debate in the UK about this. We knew the Macros Directive was coming. We had a discussion document in October 2011. We had a consultation document last year. We had quite a lot of input of views. So, bearing in mind our objective at the beginning, there's a presumption that we would implement unless there was strong evidence to the contrary, then our position is that we should implement all of the exemptions in relation to presentation and notes. Views vary according to your perspective as to whether that's a good idea or not, and I'm quite sure there are people in the audience who don't think that that's a positive thing for any company. But again, this isn't for all companies. It won't be suitable for them. Our intention is to retain the requirements for accruals accounting. So if you think back to the earlier slide, what it gave you an option to do was to not prepare certain accruals and prepayments. A couple of comments particularly around that. One is that if you are a company and a payment is immaterial to the accounts anyway, you wouldn't necessarily apply an accruals and prepayments approach already. The implication of that is that you would actually be exempting people from providing information about what was already a material payment in relation to the company. There were further concerns about the consequential impacts across other parts of legislation, so worries about how it might work with insolvency regulations, worries about how it might work around directors' duties in relation to such matters, issues about identifying distributable dividends, for example, distributable profits for dividend purposes. Thought it was going to be very confusing for small companies. If the purpose of this was actually around simplification, having to sit down and wonder whether a cost that you were looking at was eligible for exclusion or whether it had to be treated as a prepayment and accrual was going to take time and effort, was going to be difficult to understand if this was small companies wanting to prepare their own accounts. I thought that a hybrid approach would provide confusion and uncertainty for the user community as well. And I think really an overarching comment, and that was that it would reduce confidence in the UK's approach to financial statements. So our intention, as we're thinking at the moment, is to retain the requirement for accruals accounting. We will also exclude companies already excluded from the small companies regime. Two reasons for this. One, quite frankly, is so as not to cause confusion with the rest of the system. Micro companies are always small companies, so micros are only a subset. They don't have a full accounting regime or reporting regime of their own, just these very specific points. So the Commission is very clear that if the legislation is silent on something in relation to a micro, you revert to small. You are always a small company. You may be a micro within the small company. As a consequence of that, as I say, we've taken the decision that we will exclude all of those within the existing small company regime. Consistency, certainty. What it also means is that public companies in the UK are excluded from the micros regime. So I gave the list of the ones that are excluded by the directive itself, but the UK goes further, public companies are excluded as well. We're excluding charities. The charity commissioners in both England and Wales and Scotland approached the department. Because charities in the UK, and because they're not-for-profit companies, they're not actually covered by the 4th Accounting Directive, but so the Micros Directive itself wouldn't apply. But the way UK legislation is constructed, charitable companies prepare company accounts. Companies Act accounts, beg your pardon. If we left the Companies Act unchanged, without specific reference to charities, then charities would have access to the micros option. As you've already seen from the profit and loss account and the balance sheet, there's very, very minimal information there. Charity commissioners have made their case, and our proposal is that we exclude charities on the basis of transparency and public interest. We do not feel it's appropriate to permit that level of minimalist information in this instance. I mentioned earlier that all other requirements continue to apply. So the footnotes that are required on balance sheets for Companies House, things like the fact that you've taken an audit exemption, you would still have to provide. So, and we also require that, here we go. This is a really important one. We are going to provide that financial statements prepared in accordance with the micros exemption are true and fair. What the Micros Directive does is it has a little line in it, and it says that accounts prepared in accordance with the Micros Directive are true and fair accounts. So it's a deeming clause. The intention is that directors do not have to step back once they've prepared their profit or loss balance sheet and consider whether that actually presents a true and fair view. There's been a big debate in the UK's professional and regulatory community around this. Very big disquiet about the way that particular clause in the directive is written. Interesting to see that the only country whose regulations I've actually seen are Germany. Germany ignore this provision. They've taken no account of it whatsoever. France has issued a communication that indicates that they too require true and fair accounts. The way the UK law is constructed, we're concerned to ensure that there isn't any uncertainty for either the financial community, for directors or for auditors in looking at these accounts about what it is that they need to consider in terms of true and fair. So the regulations will say something to the effect of that any conflict between accounting standards and accounts prepared under these regulations will be deemed ineffective. The effect of that is intended to mean that a director doesn't have to think about whether he has sufficient notes. So long as they have the mandatory notes and they've complied with the requirements for Companies House filing, those are all the notes that they have to worry about. The fact that the accounting standards over here say that they have to have a fixed assets note or something is deemed out of scope. So there's quite a delicate balancing act going on here in the UK's approach to this. We are in discussions with the Financial Reporting Council about how we address this for the future. The Financial Reporting Council is considering issuing its own guidance that will actually say if you're preparing if you are an eligible micros business and you elect to prepare micros accounts, then you disregard these elements of the accounting standards in the UK. So we're working very closely with them in terms of how this would apply. Other considerations, clearly, micros accounts will not be suitable for all micros companies. If you're looking to grow rapidly, if you have complex relationships with your shareholders, even though you're very small, then this is probably not the way for you to go. If you have issues with trade creditors, attracting finance, etc., there may be any number of reasons. You may decide that these aren't appropriate for you, but it is the company's decision. The government is not saying this is a requirement, it's not saying that this is recommended, it's merely providing the option that's facilitated by the Micros Directive. I mentioned several times all of the Companies Act requirements continue to apply. I thought it worth mentioning this. I mean, it's kind of obvious really, and particularly in this community, must keep adequate records sufficient for their business needs. There are other bits of company law that will require a lower degree of information than will be in the published accounts. So, for example, if you decide that you want to become a public company, you have to be able to demonstrate certain things around your share premium accounts. So you have the responsibilities on the business to ensure that its financial records are sufficient to support its business needs. And we will keep this under review because we have the Accounting Directive coming along. The final point I just want to say on micros accounts is you have to be eligible as a micro in the first year that you elect to do this. If you move into the second year and you exceed the thresholds, you can elect to continue to be a micro business for accounting purposes. If in the third year you then fall below the thresholds, you retain your ability to continue to prepare micro accounts. However, if in the third year you exceed the thresholds, so for a second year, then you prepare small company accounts. So you have this ability to drop in and out of micros over a 2-year period, but you only have those two years to do that, and then you have to move back into the normal accounting regime. I don't have as much to say about the new Accounting Directive. One, because it's much more straightforward, and from a UK perspective is very consistent with the approach that the UK took in respect of the fourth Accounting Directive. That is to say, we have a small company reporting regime in the UK. That is not the case in all member states. It will have a number in there. Hopefully it will have a number in there very shortly. But that is going to be the title of the directive. As it says, it repeals the fourth and the seventh Accounting Directives. It is a new approach. If you look at the fourth Accounting Directive, what it says is, this is what you have to prepare for company accounts. Oh, that's rather a lot of information. So if you're a medium-sized company, you don't have to do this and you don't have to do that. Oh, that's still a lot of information. So if you're a small company, you don't have to do that, but also you don't have to do this and you don't have to do that. So it starts big and it comes small. The approach in the new Accounting Directive is to start small, taking forward the small first principle, and to add to it. So when you read the new Accounting Directive, and this is what it looks like, all 215 pages of it in its current print format, it starts with what the thresholds are, what the minimum requirements are, then adds to that through obligations for medium-sized companies, and then imposes a further layer for large companies. So a very different structure, and something that when we come to look at taking it into UK law, we're going to have to consider what that means for us in terms of amending the Companies Act 2006, because clearly we may have to start again. It may be simpler to start again than to try to amend what is already there. We expect adoption late summer or early autumn. I am hopeful that sometime this afternoon I will receive an email that says the Council has voted and that it's all over by the publication in the official journal, but I'm not counting my chickens, to use an English phrase. So, key features. It incorporates the Micros Directive. It has to do that. It's going to repeal the thing that the Micros Directive is wholly based on, so it had to incorporate it. It provides a new harmonised small company regime. As I've already said, the UK has a small company regime. That isn't the case in all member states. What the Commission is doing through this is making sure that all member states take away some of the burdens from their small companies. It's quite controversial in some member states, and some of you may have knowledge of that or views of it. So previously an option to have a small company regime certainly wasn't universally taken up. Commission looking to impose it. Having said it's a harmonised regime, there is some flexibility in it. So there isn't still going to be uniformity across the whole of the EU, although it may come about by default, being quite honest. There's a new approach to public interest entities, referred to as PIEs. You could be a micro company, and if you fall into one of the categories of public interest entity, you will have to prepare large company accounts. Now, we have tried our best to minimise the possibility of small companies ending up in this situation. We know we haven't succeeded in the entirety, so there will be some small companies, and as I say, potentially micro companies, who will have a significant increase in reporting burdens as we move into the new regime. Revised thresholds. I've got the size criteria on the next slide for you. It was very interesting. If you looked across Europe, certain of the northern member states were very much, we want to relieve the burdens on our small companies. We think that they can have this reduced approach to accounting. We want more companies to be able to qualify as small companies. If you look to other member states where perhaps these size criteria may mean that 98-99% of their companies are small, they are less content with this approach. So, but as I say, we do expect that this will be passed and that this will be imposed on all member states later today. Restrictions on member states in the current draft, it's Article 4.5. What that says is, we have said what the range of notes are that you can ask for a small company, and you cannot ask for more. So small member states are prohibited from seeking additional information in the financial statements from small companies. They are quite free to request that that information is provided on a separate return, but it cannot form part of the financial statements, and member states cannot require that it is published as part of the financial statements. So this is really quite a restrictive clause in terms of approaches to reporting requirements. It has a big impact in some member states. Special provisions for joint tax filing systems, these two are related really, because some member states have a single process where you file your financial statements, but the financial statements are added to in such a way that it enables the tax authorities to work out corporation tax. If you have this and this, the two don't work together. So this special provision allows that. You can ask for additional information to be filed at the same time as your financial statements for tax purposes, but it still places a restriction that says if you publish that information, you may not publish that additional requirements. So if you asked for example, something about sale of fixed assets, you wanted to sort of look into that in more detail, you can require that it's filed at the same time, but you can't publish it even though it's there. So size criteria, a substantial uplift. Balance sheet total 4 million euros, net turnover 8 million euros. This was the compromise between larger economies and smaller economies within the EU. There is an option for member states, if they so wish, to increase the thresholds for balance sheet and net turnover to 6 million and 12 million euros respectively. For those of you who are in the UK, we're in this territory, without a doubt. So the approach is that they may draw up abridged accounts. Member states must allow that they can draw up abridged accounts. It is a member state option, I do beg your pardon. They may draw up an abridged balance sheet. As I say, in the UK, abbreviated. I haven't put the detail in here. This, for those of you who are in the UK familiar with the small company regime, you'll be fully aware of the implications of this. So those items preceded by letters and numerals in the standard formats. You may draw up an abridged profit and loss account. Again, combining your figures under gross profit and loss. Greatly reduced notes, and I will just say a little bit about that. Should also say that if you make a comparison between the 4th and 7th and the new Accounting Directive, you will see a reduction in the number of available formats for companies to use. It's part of the overall harmonisation approach within the directive. So mandatory notes are reduced to just 6 items. There they are. A very big debate about that. There are some people in the room I know who were arguing not only to the UK government but directly to the Commission, MEPs and anybody else that they could find about that said that they didn't think that this was appropriate, but this is what we have. So mandatory 6 notes that all member states must require. A sufficient level of concern about those small number of mandatory notes, but member states argued for optional notes to be required, but they are restricted to 5 further notes. This one goes on a bit, and I did just want at least you to be able to see the gist of it. You can have any or all of those 5, but you can't have more. Or you can't, as a member state, require more. That restriction flows through to national standard setters. So in the UK, the Financial Reporting Council is going to have to change its accounting standards for smaller entities, the FRSI, to reflect this change in the regulatory regime. The Commission are very clear that standards form part of national GAAP. National GAAP as a whole has to comply with the legislation. We're in discussions with the Financial Reporting Council about that. Important to note, there's no deeming provision here. The true and fair override for small company accounts continues to apply. So you have a position where you have 5 mandatory notes. Member states may require 6 further notes, but directors still have to stand back and consider whether the accounts as prepared present a true and fair view. So quite a different approach. Also, if there's a requirement further on in the directive that says if you do this you must provide a note, then that note is obligatory as well. So you have to read the directive in its totality. You cannot just say, oh, the maximum notes you have to prepare are 11. That isn't true. The maximum notes the member states can require is 11. The obligations on companies goes further than that. Voluntary disclosure, of course, is permitted as always. So considerations for the UK. Obviously, we need to think about the impact on company law, what that means for our primary legislation in the UK, also what it means for our regulations for small companies, also for micro companies, because we may have to change the structure, and we're going to have to look across to implications for other legislation as well. I think this is less problematic with the Accounting Directive than it was with the Micros Directive, but certainly something that we will need to have an eye to. I've already mentioned there's an impact on accounting standards. UK GAAP as a whole has to comply with the directive. The prohibition on information applies to our national standards, so there will have to be revisions to the FRSI. And I know that the Financial Reporting Council are already thinking about that. We'll also need to think about when we're going to implement. The normal approach with EU regulations is to say that you would look to transpose working to the transposition date, which will be 24 months from the date of adoption, so it's likely to be late summer, early autumn. But going back to what I said at the very beginning, this government's policy is to reduce burdens on small companies wherever possible. This is a deregulatory opportunity. The policy may be that we look to implement this on an earlier time frame. And that is, I don't know the answer to that. You will know as soon as I do, possibly. So we will be working with professional bodies, with yourselves, to think about what the implications of that might be. What I should just say, you may see, for those who are based in the UK, you may see some debate about early implementation of the Accounting Directive. In general, those discussions at the moment only refer to Chapter 9. Chapter 9 is the transparency for extractives industries. It's hugely political. It was part of the G8. It was certainly all over the national press. We are already looking at implementation of that chapter. The accounting chapters will be considered quite separately, so this is a genuine question here as to whether we should move early or whether we work to the 24 months. So next steps, finally, formal adoption and publication of the directive. We want to establish working groups. We'll be looking to identify people from within the finance community and business community to work with us on that. We're going to need to consider the impacts. So as I've said, some of this looks quite simple, but it isn't necessarily as straightforward as it may appear on the face of it. We need to identify what that means in terms of changes in business approach, what it might mean for systems, and we need to identify costs and benefits. And work is likely to consider in earnest in the autumn. So that's it from me. Thank you very much. I have overrun, so I am around certainly until early this afternoon, so if anybody has any questions, would be very happy to have a chat in the margins of the conference. So thank you.